Hi everyone, welcome back to the FAR classes. In this particular class, which is part 3 of key term, I'll be walking you through in detail about the key terms which include service organization and financial reporting framework. And then lastly, we'll be covering notes to financial statement. So these are the three important topics as a key term we'll be covering over here in this particular video. Independent service provider organization. For example, let's say there are some company who do like payroll management. If you have heard about like ADP or OnePay, Paycheck, so these are like big companies in US who do like payroll management services for many companies, right? And there are certain company who do like inventory management, right? I'm sure like in India also you have seen when you go to the some highways you will see like a lot of big warehouses, right? Those warehouses manage inventory for multiple companies, right? Those are also kind of like service organization who manage and maintain the inventory for any third party, right? Same way, if you've seen like in India there are many companies who have outsourced their accounting in India. Maybe it's some company do outsourcing of account receivable, account payable, right, respective accounting, or maybe customer relationship management work has been very much like outsourced to country like India, Philippines, Vietnam, Bangladesh. There are so many countries in the world because of like cost arbitrage. So all this like the US companies, European company, Australian company, they set up like sometimes they set up their own KPOs or BPOs in India. But sometimes the company independently set up their KPO and BPO and tie up with some company like this, right? So why it is being happening? There's a business reason for it. The business reason for it is basically a cost arbitrage. So in the labor cost in the country like US, Canada, Australia, New Zealand, Europe, UK is more expensive than the labor cost in country like India, Sri Lanka, Philippines, Bangladesh, Vietnam, right? Especially in South Asia countries, if you see the labor cost is comparatively less. And these are, like more of, you can say, those kind of jobs which can be easily outsourced, has more of repetitive tasks, right? So if you see like in earlier days in 17th century, 18th century, or 19th century, what kind of work the developed countries were outsourcing to developing country or underdeveloped countries were manufacturing things, right? But if you have seen in the early 20th centuries, like from 2000s till date to 2022, you have seen like a shift of outsourcing the service organization work also to these countries, right? The basic reason which you have discussed is cost arbitrage. Why earlier like manufacturing setups were being done in the developing country or underdeveloped country was because of cost arbitrage, because labor cost was less, as well as like the raw material cost was comparatively less. Same is the case of like the KPOs and BPOs, because skilled labor here required be skilled labor, that cost is comparatively also less in these countries. So that's like main theme, what is service organization is and why this service organization has been developed in the developing or underdeveloped nations, right? Now coming to from the accounting standpoint of view, as well as from the auditing standpoint of view, as a CPA, what all things we need to consider. So what this service organization actually do, they intake inputs from the organization, and they do all the calculation and processing and develop, like the, you can say, great analysis as well as the reporting requirements for the company, and submit it back to the company. So in this entire cycle, from input to output, coming from the main company to the service organization and going out from service organization to the main company,
there are certain process which these company do, right? So that may be accounting process, that may be payroll management process, that may be treasury management process, that may be fund management process, that may be inventory management process. So there are certain accounting requirements and there are certain auditing requirement, there are certain control framework requirement, right? So keeping all these things in mind, we need to understand the operation of service organization and how we can ensure that appropriate controls are being managed and followed by those service organizations who are taking the information from the company, doing the processing appropriately, and giving back the processed information to the company, which company is using for their financial statement. And they are paying to those service organization, and that coming as an expenditure and accruals in the financial statement of the main organization, right? So service organization, if I simplify what we have discussed everything so far, a service organization is actually an organization or segment of an organization that provides service to the user entity that are relevant to those user entity internal control over financial reporting standard. Hmm. So, for example, your let's say your a company like Amazon. Hmm. So you are working in US and you have outsourced the payroll management service to a company called, let's say, ADP. Hmm? So ADP is one of the largest, you can say, group who do like payroll management services for the majorly for the US big companies, like including like EY. They have also outsourced their payroll management services to ADP, and they have very well professionally managed team as well as the tools to manage for all you can say country taxes as well as within the country state taxes also. Hmm? So let's say you are a company like Amazon and you have outsourced the payroll management service to ADP, right? So you would be curious to know what all controls that ADP have, what all processing that ADP do, and how your information will be taken into those organization, and how you'll be ensuring confidentiality of the information which you have shared, and how you will be ensuring the information which this company will be giving you back, and that you are considering for your financial statement is appropriate, accurate, right? So for that, there is some reporting requirement. Hmm? That reporting requirement is on internal controls. So those reports are called SOC 1 report and SOC 2 report. If you are a non-issuer, if you are a non-issuer, then probably you require a SOC 1 report. And if you are an issuer, then you mandatorily require SOC 2 report. So what is SOC 1 report and what is SOC 2 report? Why for a non-issuer SOC 2 report is not mandatory, and why for an issuer SOC 2 report is being mandatory? SOC 1 report is based on the auditor who is a service organization auditor conducting the audit on design effectiveness of the internal control at the service organization. They issue SOC 1 report, right? For a private company, for a non-issuer, internal control over financial reporting audit is not mandatory. So that is the reason for them it is sufficient to have SOC 1 report, because they are not required to test the internal control. But management can request the service organization to provide them SOC 2 report for, like it's not mandatory, but it's a good practice to do that, right? Second thing, for the issuers, if you are an auditor of issuer, you mandatorily have to issue a report on the internal control over financial reporting, their design effectiveness as well as operating effectiveness, right? Hence certain controls are being designed and operating at service organization. So you would be requesting management, you will be requesting management to get the SOC 2 report from the service organization auditor, where service organization auditor will be doing both testing of design effectiveness and operating effectiveness of internal control, and based on that they will be issuing SOC 2 report that you will be considering it. So this SOC 1 report and SOC 2 report, why it is being required in accounting, right? Whether you are doing correct accounting or not, it matters a lot on the internal controls, right? As you have been outsourced, so you'll be curious to know, and it's being your responsibility to know whether that outsourced company or the service organization have appropriate internal control to process your information and give you right information back or not, right? For
So I have a
that
question.
reason, yes,
I have a
please.
question over here. So
Hmm.
if the service organization is also a non-issuer and the auditor is just auditing the design effectiveness of the control, then how
Hmm.
can we like gather and obtain SOC 2
Mhm.
report in that
That
case?
will be, yeah, very good question and very practical question, Gurmeer. For example, let's say ADP is a private limited company, or maybe let's say C Corporation, which is not a listed. Like if you see, go to the Google, look at Paycheck, OnPay, ADP, they are not listed company, right? But if you see their clients are like Amazon, Walmart, General Motors, EY, many listed clients, right? So when those listed client entered into service organization agreement with them for management of their payroll, it's being one of the key terms and condition that you have to ensure design and operating effectiveness of internal control, and you need to issue a SOC 2 report from your auditor. So even though
Oh,
for company like ADP, Paycheck, OnPay, they are not listed company, but it's their client requirement. So they have to do ICFR audit. Make
okay.
sense?
Yeah,
Hmm. That's their business requirement. Otherwise, they won't get big clients.
yeah, right, right. Okay.
Hmm. Cool. So this is all about service organization. In audit, we will be discuss. We have discussed in detail, and when it comes to your audit section of exam, we'll be discussing again more in detail. But from account standpoint of view, FAR standpoint of view, just having a high overview, high level understanding about service organization is sufficient, right? Next thing is related party. So related party include affiliates of the entity of for which investment in their equity security would be required, absence of election of the fair value option to be accounted for by the equity method by investing entity. So equity method investment, in a short, if I say point B, we'll be discussing this in detail because related party disclosure is part of FAR. But here you should just have an understanding. At this point of time, we are just touching the concept of related party. We'll be discussing more in detail. So this is a specific section we have in chapter number 4, right? The next one is trust for the benefit of employee, such as pension trust, profit sharing trust, that are managed by or under the trusteeship of management. So where management is the trustee of the trust in which employee pension scheme or any other profit sharing benefits or long-term employment benefits are being managed. So that trust is also called related party if it is comes under the same management. Hmm? Third is principal owner of the entity and the member of their immediate family member. That means shareholder of the company and their family member. Next is management of the entity and the member of their immediate family member. That means board of director, CEO, CFO, and their family members. Next is other party with which the entity may deal if one party control or can significantly influence the management or operating policy of the other entity to the extent that one of the transacting party might be prevented from fully pursuing its own separate interest. So where an individual or an entity have an influence on the another entity in making their policy and taking their financial decision. So then that entity would be considered as the related party of the entity in which the other entity do have influence. The last one is other party that can significantly influence the management or operating policy of the transacting party, or that have an ownership interest in one of the transacting party and can significantly influence the other party to the extent that one or more transaction party might be prevented from fully pursuing their own interest. So where one party has a significant influence, it may be individual, it may be firm, it may be trust, it may be any other business entity that can influence the other company in taking the decision for any particular transaction. Maybe let's say purchase of raw material. Let's say, for example, you are a company, let's say you are a company like Hyundai. And Hyundai do purchase, let's say, automotive parts from, let's say, Motherson Sony, or they take, let's say, tire from Goodyear, Bridgestone, right? They take some, like spare parts from ASK. Let's assume. So here there is a one person who has influence on the management of Hyundai, and they request Hyundai management to buy the particular spare parts from, let's say, ASK Automobile. Even though it's not being in the interest of Hyundai, it may be expensive than the market, but Hyundai will be taking that decision under his or her influence. So that person who has influence is being considered as the related party of Hyundai. Right? If I summarize everything very quickly and very crispy, what is related party you need to keep in mind. All the affiliates mean your subsidiary, your joint venture, or where you have done some equity investment. Second is any equity method investment you have made in any entity. Any trust in which the trustee and your management is same, right? Principal owner, that means main shareholder and their family member. Management, that is board of directors, CEO, CFO, finance controller and their family member. And then any other party which has influence in taking the management decision and policies, and the party who is getting benefit out of those transactions has been considered as a related party. Simple, makes sense? So we'll be discussing very much in detail in chapter 4, but here just high level overview. What when any word comes related party in first chapter, second chapter, third chapter, like you should not be feeling like who is related party. Make sense? Shall I move forward? Next term,
Yes, sir.
next term you will be oftenly seeing is those charged with governance. So those charged with governance are often referring to the audit committee for issuer. In case of issuer, those charged with governance are most of the time considered audit committee, right? If one exists, if one of the following exists, but the meaning of the term is not limited to the audit committee, rather extend to the person with the responsibility for overseeing the strategic direction of the entity or obligation related to accountability of the entity, which include overseeing the financial reporting requirement. That is like approving the financial statement, like CEO might be signing the financial statement. So CEO would be considered as those charged with governance. Managing director will be signing up the financial statement. So managing director will also comes under those charged with governance, right? In some of the entity, governance is a collective responsibility that may be carried out by the board of director and the committee of the board of director or committee of the management partners equivalent to the person or some combination of those. Then for issuer, most of the time it consider audit committee, but it can be the management and audit committee or the board of directors or the partners or equivalent or combination thereof, right? So practically we have seen most of the time it's audit committee, but theoretically it can be the combination of any such, right? Those charged with governance are specifically excluded from management unless they perform management function. So ideally, those charged with governance should be over and above the management, should not be the part of management. So who is management? Like CEO, CFO, finance controller, vice president, president, AVP, right, of the respective business unit head. So those people comes under the management category. Those charged with governance should be different than the management. There might be possibility one or two management person are part of those committees, which is considered as those charged with governance, but not majority, right? Those charged with governance are
Those charged with governance is superior to management.
ideally, yes.
Oh,
So like board of director, audit committee, independent auditors, right? So maybe some committee in which you can say it's a combination of management and independent director and board of director, but management participation would be very limited.
सर बोर्ड ऑफ डायरेक्टर्स वगैरह तो सर नॉन लिस्टेड में होता है ना आइडली?
नहीं, it's been both for both, whether it's issuer or non-issuer. Every company have its board of director. Independent director requirement is for issuer. For non-issuer, it's not mandatory.
ओके एंड सर स्टेक होल्डर्स वगैरह नॉन इश्यूअर में आते हैं, राइट?
No, shareholder is also in all type of company.
ओके.
So in a private company, generally shareholder and directors are same. But in public company, shareholder is general public and some key shareholders, which are like financial institutions, or like if you see Amazon, Jeff Bezos has 16% share, 84% share is with the market, right? And if you see the breakup of those 84%, only 26% share is with the general public, right? Rest of the share are with the big financial market players, right? So those shareholders appoint the board of directors, appoint like managing directors, right? And they do like they further appoint like CEO, CFO, finance controller, head of the accounts, head of the business, head of sales, head of marketing, presidents, vice president, those all things, right? So all those things, all those people who are like like CEO, CFO, CEO, CHO, CTO, head of the accounts, controller, all these people come under the category of management. Board of director, advisory board, they comes under those charged with governance. Make sense? Yes, no?
yes, sir.
Yes, sir. Got it.
Okay. Financial reporting framework, I think we have already covered. Financial statement also we covered, like financial statement position, statement of income and expenditure, change in equity, change in other comprehensive income, cash flow, and notes to accounts. So this is called main financial statement, right? There are some supplementary information, or there are certain required supplementary information which is not part of main financial statement. When any question come, whether this statement, like there might be a multiple choice question, identify the statement from main financial statement. They may give you like option like MDA, management discussion and analysis, industry analysis, director report, and the cash flow statement. So then you need to select cash flow statement, because that is the main financial, that is a part of main financial statement, right? Those kind of question you will see. Next is notes to the financial statement. What is notes to the financial statement? Basically, they are explaining the significant accounting policies and principle adopted and used by the management in the preparation of financial statement, right? If you see this, so if you see this General Motors financial statement, so what is this? This is accounting policies. 1 second, I'll take it. Yeah. So here, if you see the accounting policies, principle of the consolidation, like how they have done the consolidation of financial statement, use of estimate, where they have used the estimate, general financial, GM financial, significant accounting policy. First one is revenue recognition. What all things they have considered for revenue recognition? What all revenue recognition policy they followed for GM auto and for the GM financial, right? And then advertisement and promotional expenditure, how they dealt with research and development expenditure, how they dealt with what they have considered as cash and cash equivalent or restricted cash, right? What they have considered for calculation of the fair value measurement, what policies and principle or method they have used, right? Observable input, unobservable input, all those things. How they have accounted for marketable debt security, how they have accounted for receivable, financial receivable, inventories, right? Equipment and operating lease, equity investment, property, plant and equipment, goodwill, intangible. So you need to disclose all this information into your financial statement, and these are part of notes to accounts. So notes to accounts always be first thing is the accounting policies and principle which you have used for the entire financial statement preparation should always become very first notes to accounts. Make sense? Yeah, Vineet, Gurmehar, Kashish.
सर एक बार ही रिपीट करना सर लास्ट लाइन आपने बोली थी.
So have you seen this accounting policies?
Yes sir.
So accounting policies, always we need to disclose first notes to accounts, because accounting policies are basis on which entire financial statement have been prepared. What all rules, regulation, principles you have followed for the respective category of accounting, that you need to mention in the accounting policies.
Okay, sir. कौन सा method we are following that section will come into notes to accounts.
Yes, yes. For example, for inventory, you are using LIFO, you are using FIFO, you are using weighted average. You need to mention here, right? For let's say for lease accounting, how you have identified operating lease, how you have identified finance lease, how you have identified sales type lease, that you need to mention. Yeah. For hedge accounting, what you have considered as currency hedge, what you have considered as interest hedge, what you have considered as a hedge for cash flow statement, right? Those things, policies you need to mention here. Make sense?
Yes. तो सर फिर स्टैंडर्ड बोर्ड सर फिर डायरेक्ट नोट्स टू अकाउंट्स देखकर ही पता लग जाएगा उसको कि हमें एक्चुअल में जब ट्रांसलेट करेंगे दूसरे में तो फिर हमें कैसे वो करना है.
Yes, yes. That is the reason I'll be sharing these two financial statement with you, and this is your homework for today's, so that like in tomorrow class, if you have any doubt on any of these financial statement, we'll be more than happy to discuss those. That will be beneficial for everyone in the group, right?
Yes sir.
So now coming to the notes to financial statement back. So first thing is significant accounting principles and policies used, or alternative measurement of assets and liability that you need to provide. Second is information about long-term obligation, when they are due, interest rate, restrictive covenants they have, inventory measurement, revenue recognition, discussion of contingency, claims, assessment. All these things need to be comes under the notes to accounts.